I have spent most of my life watching people panic at the wrong part of the balance sheet. They look at the biggest number on the page, feel a rush of fear, and assume the size of the number itself must be the danger. Then they miss the terms, they miss the incentives, they miss the structure, they miss who is really paying, they miss who is really benefiting, and they miss the difference between a problem that is loud and a problem that is expensive. That is how I think about America as federal debt. For as long as many people can remember, they have been told the national debt is the crisis waiting. Just over the horizon, the debt clock keeps climbing. Politicians trade speeches about fiscal responsibility depending on which side of power they happen to occupy. Every few years, the country acts as if it is one dramatic news cycle away from a historic reckoning. Then the deadline passes, the ceiling gets lifted, the borrowing continues, and ordinary people go back to work feeling vaguely anxious but not much wiser. That pattern creates a dangerous kind of complacency. When the country crossed $10 trillion in debt, people said the end was close. Then it crossed $20 trillion. Now the number is moving toward $40 trillion, around 130% of GDP, with almost half of outstanding borrowing added in just the past 6 years. If you have been hearing warnings for a quarter of a century and the grocery store is still open, the lights are still on, and the Treasury still pays its lenders, you begin to assume the warnings were all theater. That is the first mistake. The second mistake is to assume the absence of collapse means the system is healthy. I have never found those two things to be the same. The right question is not why America has not turned into a cartoon of national bankruptcy. The right question is why a government can spend roughly $15 trillion more than it takes in over half a decade, and yet ordinary families do not feel $15 trillion richer. If you want to understand the answer, you have to stop thinking about the debt as a moral slogan and start thinking about it as a business problem. A business can carry a great deal of debt for a very long time if the cash flows are reliable, the financing market remains open, and the lenders believe the claims they own will still be valuable when they get paid back. That last part matters most. The real risk is often not non-payment. The real risk is payment in money that buys less. The real risk is getting your principal back in a world where the currency is weaker, inflation has eaten the value, or the system that made the obligation attractive no longer commands the same trust. That is the lens I would use here. The United States has never really frightened serious capital because investors believe two things at once. First, the government could always find a way to meet a nominal obligation. Second, Treasury securities sat at the foundation of global financial plumbing, which meant they were not just loans to a government. They were collateral reserve assets, benchmark rates, and, in practical terms, one of the central load-bearing beams in the architecture of modern finance. Once you understand that, the picture becomes clearer. The debt is not harmless, but the danger is not as simple as the debt clock. The danger is that the structure gets more brittle while the political class keeps treating it like a stage prop. People hear the phrase debt ceiling and assume it means a government standing at the edge of some objective financial cliff. That is not how I would describe it. The debt ceiling is much closer to watching somebody refuse to pay their own credit card bill while insisting the refusal proves they are newly committed to budgeting. The absurdity is part of the point. When the ceiling was suspended, the government could keep borrowing without the same self-imposed limit. When that suspension ended on the 1st of January 2025, the ceiling returned and the government was already pressed against it. That did not mean Washington suddenly stopped functioning. It meant the Treasury had to rely more heavily on the Treasury General Account, effectively the government's checking account held at the Federal Reserve, where taxes and other receipts go in and government spending and debt repayments come out. At one point, there was more than $900 billion in that account. During an earlier stretch, when the ceiling was back in force and new borrowing was constrained, the Treasury spent the balance down from a bit over $800 billion to less than $300 billion over roughly 6 months, helped along by April tax receipts. Once the ceiling was raised again to about $41.1 trillion, borrowing resumed, debt expanded further, and some of that cash was used to refill the account. That sequence matters because it shows you what the immediate fight is really about. The immediate fear is rarely that the United States has somehow run out of abstract wealth. The fear is that a political standoff could leave the checking account thin enough that the government would have too little cash on hand to cover ordinary operations and debt service on time. America came perilously close to that outcome several times in the past 15 years. In 2011 and 2013, and again in 2023, lawmakers used the debt ceiling as leverage in broader fights over deficits, health care, and spending. During the climax of the 2023 confrontation, the Treasury reportedly had less than $40 billion left in the account, even after extraordinary measures. That was less than 2 days of regular spending. Think about that for a moment. The world's largest economy, issuer of the world's reserve currency, cornerstone borrower in the global system, standing within roughly 48 hours of a self-inflicted payment crisis because politicians decided to shake the Jenga tower to improve their negotiating position. That is not fiscal discipline. That is governance risk, and governance risk changes the price of capital. If I lend to a borrower who is rich enough to pay me but erratic enough to delay payment for avoidable reasons, I do not say the risk is zero. I say the risk has changed form. It is no longer just credit risk. It is operational risk. It is confidence risk. That is what the United States has been manufacturing. Not insolvency in the classic sense, distrust after the 2023 standoff. Fitch downgraded U.S. credit from AAA to AA. Whether one agrees with every ratings agency decision is not the central issue. The signal matters. The downgrade was an admission that the world had to price not only America's economic capacity but also America's political willingness to handle its own obligations without theater. A great franchise can survive foolish managers for a while. It does not get a free pass forever. Now let me get to what I think many people misunderstand most. They think if the United States can print dollars, then it cannot have a real debt problem. That is too shallow. It is true in a narrow sense that the federal government can always create nominal dollars. If all you care about is whether the lender gets pieces of paper or digital entries with the promised number attached, then the risk looks tiny. But that is not how serious investors think. They do not just ask whether they will be paid, they ask what they will be paid in, what those dollars will buy, whether those dollars will remain central to trade and finance, and whether the collateral role of Treasuries will stay unquestioned. A delayed payment is annoying. A depreciated payment is dangerous. A reserve asset that begins to look politically contingent is dangerous. A currency that faces declining external demand is dangerous. And once lenders start seeing those risks, they do what lenders always do. They demand compensation. When the Treasury needs money, it does not stand in the town square and beg. It effectively conducts a reverse auction, offering higher yields until buyers step in with enough capital. If buyers become less comfortable with the future value of the dollars they will receive or with the smooth functioning of the system surrounding those dollars, they ask for more yield. If rates in the broader market are higher, they ask for more yield. If the country keeps issuing new debt into an already crowded market, they ask for more yield. Then something predictable happens. The government rolls more and more existing debt into newer, more expensive obligations. Interest expense climbs. Then the debt stops being merely a large stock and becomes a punishing flow. That is where the story gets serious. The United States is now dedicating around 4% of GDP just to interest payments. In budget terms, interest service has risen to something like a fifth of federal spending. The source material makes the same point in practical language. The amount devoted simply to covering interest has almost tripled in the last 5 years. This is what separates a mortgage from a credit card. A $20,000 obligation is not a $20,000 problem in isolation. The rate attached to it determines whether it is manageable, irritating, or destructive. People sometimes comfort themselves by saying debt to GDP improved from the pandemic extremes, down from roughly 132% to about 121%. That sounds like progress, and I understand why people reach for it, but it is incomplete. First, the comparison starts from a lockdown period distorted by emergency borrowing and suppressed output. Second, if you zoom out beyond that anomaly, the longer trend remains ugly. Third, and this is the most important part, total debt ratios alone do not tell you what the cash burden of the debt has become. A government does not service debt with percentages on a chart. It services debt with dollars. If the nation must devote around 4% of GDP to interest alone, then even very good economic growth barely keeps pace. The source argues that 4% real GDP growth every year would be considered extremely strong, while average annual growth since 2000 has been closer to 3%. In other words, even the optimistic arithmetic is not optimistic enough. That is why I do not put much weight on the phrase "we will grow our way out of it." Politicians love that line because growth sounds painless. Nobody wins office by promising sacrifice. It is always more popular to tell a debtor he can solve the problem by becoming richer. Sometimes that is true, often it is true too late. If your interest burden is already consuming the same ground you hoped growth would reclaim, then growth is no longer a rescue plan. It is a treadmill set just fast enough to keep you from falling off while the machine heats up. The next popular fantasy is inflation. People say the government can simply inflate its way out. Since Treasuries carry nominal face values and many have fixed rates, higher inflation reduces the real burden of outstanding obligations. That is true once, just as the source notes. It is also why people keep returning to the idea. But lenders are not livestock. If you surprise them with inflation and silently erode the real value of the claims they own, they do not stand there politely and finance the sequel on identical terms. They demand higher yields the next time around. They ask to be compensated for anticipated erosion, they diversify, they question the role of the currency, they become more expensive counterparties, and ordinary families pay the price before the policy theorists finish, congratulating themselves. Inflation is often described in sterile macro language, but to me it is one of the cruelest taxes because it attacks people who have the least room to maneuver. Wages do not always catch up. Savings held in ordinary cash get weaker. Daily life becomes harder to plan. The source makes the same point directly. Higher than expected inflation would undercut the dollar, hurt people already living through a cost of living crisis, and likely do more harm than good. I agree you can reduce the real value of debt by damaging the real value of money, but you do not emerge from that process with trust intact. And trust in finance is not a decorative asset. It is the asset that leaves the least glamorous options: raise taxes, cut spending, or accept a very long season of low growth and financial repression, the path the source loosely compares to Japan. Now, cutting spending sounds easy until you look at the composition of spending. A great deal is not discretionary in the short run. Pension commitments, healthcare programs, and debt interest are not categories one can casually trim without rewriting major rules or breaking promises that millions of people have planned their lives around. Interest itself is now one of the largest expense lines, and you do not cut interest without either lowering rates, paying down debt, or defaulting. Military spending sits nearby as another huge line item. But even there, the source notes two political constraints. One is the strange posture of being at once more isolationist and more interventionist. The other is more prosaic and more revealing. Military recruitment is up, which may reflect patriotism for some, but also may reflect a weak civilian job market, especially for young men. That means military spending is not only a defense question. It is also entangled with labor market weakness, regional employment, and social stability. That is what makes debt problems so much harder than television arguments suggest. They are never about one number. They are about the network. I have long believed that when a system becomes too complex for honest discussion, slogans multiply and solutions disappear. That is exactly what has happened here. One camp says slash spending, another says tax the rich, another says growth will save us, another says inflation will dilute the burden, another says nothing bad has happened yet. So the warnings are exaggerated, all of them contain fragments of truth, none of them solves the full puzzle alone. Still, there is one area where I think the source lands on a point too many people instinctively understand, but too few powerful people want to say out loud. The burden is shifted. Federal receipts as a share of GDP have remained surprisingly stable for many decades, even compared with eras when top marginal tax rates were far higher on paper. People cite that fact to argue taxes cannot solve the problem. There is some truth in that. Taxes alone will not erase an imbalance created by much larger spending commitments, demographics, interest costs, and structural drift. But that same statistic is often used to dodge the more interesting question, who is paying and who is benefiting? According to the source, the tax burden has shifted more toward middle-income earners and away from wealthy asset owners, while a growing share of government spending flows through grants, credits, contracts, subsidies, guarantees, bailouts, and various partnerships that are ultimately captured by private enterprises and then reflected in shareholder wealth. That is a very important observation if government spending supports asset prices, corporate profits, and institutional balance sheets, while the tax load leans more heavily on workers and middle-income households. Then the deficit is not merely a national abstraction. It is also a mechanism of distribution. You begin to see why so many ordinary people do not feel richer even after the government has spent trillions beyond what it collected. The money did not disappear, but it did not land where the headlines imply. A great deal of it moved through channels that support institutions, preserve valuations, stabilize sectors, subsidize favored activity, and strengthen balance sheets higher up the ladder. Meanwhile, the financing burden imposed on ordinary workers reduces the very spending work and reinvestment capacity politicians claim they want from the middle of the economy. That is not just inefficient, it is corrosive. I have always been suspicious of arguments that pretend wealth can be harvested only from labor, while capital remains on a velvet cushion. If institutions and wealthy individuals are among the largest net buyers of government debt, then it is perfectly fair to observe, as the source does, that if they can find the money to finance the deficit through bond purchases, they can find the money to contribute more directly through taxes. I do not say that as a slogan. I say it as arithmetic. The present arrangement asks workers to shoulder increasing pressure while allowing the system to continue delivering a large share of the upside to owners of capital and assets. Then it acts surprised when growth disappoints, politics turns venomous, and trust frays. What did people think would happen? Now, let me make another distinction that matters. A debt problem can hurt you in two different ways. The first way is dramatic. Missed payments, funding gaps, failed auctions, a full-blown crisis of confidence. The second way is quieter. Higher rates that bleed the budget, a currency that commands slightly less deference, greater sensitivity to shocks, weaker fiscal flexibility, periodic political blackmail, a government that must keep issuing more debt on less favorable terms, simply to maintain yesterday's promises. Most wealthy countries get injured by the second, way long before they are destroyed by the first. That is why the national debt debate often feels unsatisfying to ordinary people. They keep waiting for the cinematic form of the crisis. Instead, they get something more familiar: higher financing costs, more political dysfunction, less room for useful public investment, weaker household purchasing power, and a system that feels increasingly expensive without feeling more generous. That is the debt becoming a problem. Not when the number first looks absurd, when the trade-offs begin colonizing daily life. The source offers 6 broad paths: grow out, inflate out, raise taxes, cut spending, turn into Japan, or keep kicking the can. If I were forced to translate that into plain English, I would say there are really only 2 paths that political systems choose willingly. The first is to promise painless solutions. The second is to postpone painful ones. America has specialized in the second while narrating it as the first. That cannot continue forever. The road ahead, in my view, is less about identifying a single magic answer and more about recognizing the hierarchy of bad choices. Pure growth is insufficient once interest expense itself absorbs so much of the runway. Pure inflation is an act of financial vandalism disguised as cleverness. Pure spending cuts run into political reality. Contractual commitments and social fragility, pure tax rhetoric without structural reform does not solve the mismatch by itself. And a Japan-style path of low growth, low inflation, and low rates may reduce volatility, but offers little joy and less dynamism, especially for a country accustomed to treating the upward slope of asset prices as a national birthright. That leaves the hardest but most honest road. A combination: more realistic taxation of wealthy asset owners and institutions, serious scrutiny of spending that chiefly socializes risk and privatizes upside, a refusal to use the debt ceiling as a hostage device, a commitment to making the borrowing road smoother if the country insists on rolling debt forward, a recognition that reserve currency status is not a law of nature, and an adult admission that debt service is now so large that every bad decision makes every future decision more expensive. You do not solve a leverage problem by lying about the cost of leverage. You do not solve a trust problem with louder press conferences. You do not solve a distribution problem by pretending the beneficiaries and the payers are the same people. The older I get, the more I believe that a society reveals itself by which obligations it treats as sacred and which sacrifices it assigns by default. America has treated the preservation of asset values, the smooth functioning of markets, and the continuity of borrowing as sacred. It has treated the pressure on workers, savers, and taxpayers as adjustable. That arrangement can survive for a long time. It cannot survive without consequence. If you ask me when the debt becomes a genuine crisis, I would not point you first to the size of the debt clock. I would point you to the moment lenders no longer assume the system surrounding Treasuries is smooth, apolitical, and dependable. I would point you to the moment interest costs crowd out real choices. I would point you to the moment citizens realize they are financing a machine that protects balance sheets more reliably than it protects living standards. By the time all three are obvious at once, the correction usually becomes much harder. The sensible response is not theatrical panic. It is disciplined honesty. The country needs to say out loud that the debt ceiling game is foolish and dangerous. It needs to say out loud that nominal payment capacity is not the same thing as real financial health. It needs to say out loud that interest burden matters more than headline ratios when the ratios become so large. It needs to say out loud that middle-income workers cannot keep being treated as the default shock absorbers of a system whose upside increasingly pools elsewhere. And it needs to say out loud that if powerful institutions can fund the deficit through financial claims, they can fund a greater share of the republic more directly. I am not under any illusion that politicians will choose this path quickly. The source is right about the tragic reality. Governments rarely act while optionality remains. It is easier to make the future somebody else's problem. It is easier to promise that growth will arrive. It is easier to present a debt ceiling standoff as heroic courage. It is easier to let inflation nibble quietly and blame somebody else for the grocery bill. It is easier to tell taxpayers everything is under control while interest charges consume more of the budget each year. Easy is not the same as durable. That is the whole lesson. When I look at a leveraged enterprise, I ask a few simple questions. Can it meet its obligations? On what terms can it refinance? Who bears the cost of maintaining the structure? What happens if confidence slips a little? What happens if confidence slips a lot? And how much of its operating freedom has already been mortgaged to preserve the appearance of stability? Those are the questions I would ask of America's fiscal future. The answers are not catastrophic yet. They are not comforting either. The debt is not a crisis because the number is large. It is a crisis in slow motion because the structure has grown more expensive, more politicized, and more unequal, while the country keeps pretending that borrowing is the same as prosperity. It is not. Borrowing can buy time. Borrowing can smooth a shock. Borrowing can finance real investment. Borrowing can preserve a nation during war, recession, panic, and transition. But borrowing is not wealth. A debt-funded illusion of wealth is still an illusion. And if a society wants to remain rich in more than headlines, it eventually has to decide who will bear the real cost of the promises it keeps making. That is not an accounting question. That is the question.